And then, all right,
Yep.
we're broadcasting to all attendees. So to everybody who's joining, welcome. I'm going to pass it over to Chair Kawafuchi in a moment. My name is Seth Colby. I just want to reiterate the fact that if anybody has public testimony, they are encouraged to send in, they can send in written testimony to the email, always post it in the agenda beforehand. And if they do not, we will have a question. People will be able to submit questions and other ideas for a question and answer session in a few moments. So you might want to prepare for that as Kurt begins the meeting. Other than that, I'll pass it on to Chair Kawafuchi.
Okay, Happy New Year, everyone. Want to call the meeting to order. So the first item is there any are there any communications to the Council of Revenue?
Yes.
Yes.
There's the letter that I sent to all of you from Director Choi. Should I go, would you like to read it or would you like me to read it?
Could you read it?
Yeah, I can read it just so everybody on the call can listen to it. Gentlemen and ladies, federal and state governments are giving various types of subsidy and relief to individuals, businesses, governments because of the COVID pandemic. The taxation scheme for many of these programs has yet to be determined. For example, for the general excise tax, rental subsidies for businesses could be subject to taxes as income replacement and at the landlord level for rental income. The distribution of food cards could also be taxable to individuals. Further, there could be behavioral changes where people who got subsidies may be saving these monies instead of spending it. I would like to know how the Council on Revenues is accounting for these revenue streams in its tax revenue projections for the fiscal years ending June 30th, 2021. Thank you. Yours truly, Isaac Choi, Director of Department of Taxation.
Okay,
And just quickly, I did include a tax announcement as well that may help you guys think about these questions as well.
Okay. I'd like to open it up for discussion.
Well, I think there has been evidence that a lot of people are saving money rather than spending it all. People were concerned about the economy and how things are going to be, and savings rates, as we did see earlier in the year, just skyrocketed. So certainly not all of the benefits that were dispersed were spent.
Can I make a comment?
Sure.
Okay, with respect to the PPP funds, although the IRS had early indicated that deductions related to amounts received for the PPP funds would not be deductible, the recent legislation under the Consolidated Appropriations Act at the end of the year, that clarified that deductions related to receiving the PPP funds would also be deductible. So you have a situation, so the money comes in from the government and it goes to the businesses, and the businesses don't have to pick that up as income, and yet they're allowed to take the deductions for which those grants were related to. So it's going to be a pass-through capital infusion, you might consider that, to the small businesses for the PPP. And that was qualified or clarified at the end of the year. And in my opinion, that money that came to the small businesses are money that's equivalent to blood transfusions to save patients who are rapidly bleeding to death. And so I don't think that the state, personally, I don't think the state should try to tax that money that went to the small businesses, because from what I've seen, small businesses have really suffered through this pandemic. But if we had made assumptions earlier that that money was going to be taxable and brought into income for the general fund purposes, I'd like to point out that we should revisit that point, because it's a substantial amount. If you looked at the amount of PPP grants that came through, the information that Seth has sent, and you multiply it out by maybe even 6%, that would amount to quite a bit of taxes that we wouldn't see in the general fund.
Marilyn, do we know for a fact whether or not, I mean, they haven't voted on any conformity bill yet with regard to that, right? So, I mean, is there any indication, has anybody heard any indication of the way that the state's leaning as far as the legislature in conforming to the federal law for that treatment?
Well, from what I've seen, I don't believe that, the AICPA was very, and all small business groups are really lobbying to have all of this so that it was deductible by the small businesses, because they felt that it was not right for those funds to be taxable to the small businesses. So, that money is going to come in and go out. So it's not going to be taxed by the feds. In addition, there was additional money that people receive for rent, mortgages and all that like Maui County gave us money, the small businesses, for offsetting rent, mortgages, and utilities. And that money, I understand, would be taxable to the small businesses. The money that was for rent, for going of rent to the individuals, where the state came in and paid for the rent for individuals and paid it to the landlords, that money is not taxable to the, this is from what I'm reading anyway, that money is not taxable to the recipient because they qualified under welfare rules, but it would be taxable to the landlord.
So there's a couple of issues here. One, in terms of existing assumptions that, Marilyn was asking whether we're assuming that this income is taxed. The only place that those assumptions show up is in our models. And our models are estimated based on historical data, which means that if something is counted in income, then our models effectively assume that it's taxed because historically it is. And so it is true that our models are assuming that money that shows up in income under the CARES Act, whether it's a PPP loan or a transfer payment, it's assuming that it's just the same as any income in any other year. And so in that sense, it would be overestimating tax revenues if that income is not subject to tax. The information that Seth provided suggests that under existing law in Hawaii, the PPP loans, for example, would not be taxed. That was at least my interpretation of what Seth sent. And the one that is to me the most surprising is that not only will the grant, because these are essentially grants now, they're not loans. It's one thing for the grant not to be taxed. It's another thing for you to then turn around and deduct the expenses on which you spent that grant money. So it's really kind of a double whammy. What I don't know, maybe Marilyn can answer this, is so if a business has no revenue and they spent the CARES money to pay employees or to pay their rent, but they have no revenue, what's the tax implication in terms of deductibility of expenses?
You're still allowed to take the deduction for the employees.
In the current year?
Yes, for 2020. So
regardless of not having any revenue or any income.
Because that money is non-taxable coming in, and the latest law that just passed in December, the end of the year to 2020, now says that money that deductions are still allowed to the businesses that receive the money. Now, this is contrary to what the IRS had in their rulings earlier in the year. They had couple rulings that said, no, that money for the PPP loans, you couldn't deduct the related expenses that were used to acquire the PPP funds. But at the end of the year, Congress clarified that their intent is to make it so that that is not going to be taxable income. So what you're looking at is a cash infusion to the small businesses to keep them going, and basically to keep the employees of the small businesses that have PPP loans, keep them so that those employees remain employed. So whether or not it's an unemployment or not, but whatever the case may be, that is how it is to save the businesses.
So I understand all of that. I understand the intent. I understand the changes in the federal law. And so what I'm saying is that you take a restaurant, for example, that maybe received a $1 million loan, which they then spent on their employees, but they've been shut down with no business revenue, and the only expense was say that employee expense and maybe rent. So they're not going to pay tax on the PPP loan. Are they going to be able to deduct the expense against? So in other words, they have no revenue. They're showing a loss, and will they be able to deduct from their taxes the expense for employees and rent for the current year?
Yes, they would be.
Yeah.
Okay.
And Carl,
That's what I wanted to know.
Carl,
The impact
So
may
we
be
might end up in a
deferred to.
situation where businesses have net operating losses in the current year that they can carry back.
Yeah.
So,
Yeah, so that's what I was going to suggest, Marilyn, is and Carl it could potentially be a larger cash drag for the state, primarily because if filing carryback claims, NOL carryback claims, so there's going to be refunds springing back from prior years. So there's potentially that impact as well.
That was what I was trying to get at without that. I didn't get the question out was, what the timing effects were. Thanks.
So just we're looking at this. We have not come to a final conclusion with this. Our current belief is, or it would impact it in the future, right? So under Hawaii tax law, it's not like the federal law. So you cannot take things going backwards. You have to take things going forward, right? So that would imply if we did adopt this, there would be the impacts would be, the net operating loss would be claimed in the future.
Yeah, I think that's right, Sid, because when the CARES Act was passed, they allowed for a 5-year carryback, but Hawaii has not yet, when they adopted some provisions from the CARES Act, they did not adopt the 5-year carryback provision. So my recollection is Hawaii law did conform to the 2017 law, which only allows losses to be carried forward, not carried back.
So, but you won't have future income possibly. And the PPP2, the latest version of the PPP, basically has more restrictions so that, you'd have to have any quarter of 2020 be 25% less than the similar quarter in 2019. But the provisions as far as for those who qualify, it's same thing. You still get the deduction for whatever amount you're receiving a PPP2. So
I think that also applies to PPP1, right, Marilyn? Don't you get the deduction
yes.
for PPP1? But Hawaii has not yet adopted that, right? Those provisions that allow the taxpayers to claim the deductions on the PPP loans that are forgiven.
Are you saying the state can make a decision to tax those for the state of Hawaii?
I think we need a conformity bill, right, to make it has to make it exempt, right?
I would just like to point out, if I may, if you're not allowed to deduct the expenses, then it's basically a taxable income to you.
That's correct.
So by not allowing the expenses to be deducted, we would basically have taxable income, and I don't think that was the intent.
Yeah, I think the correction is like they get their cake and eat it too, in the sense that they get the loan forgiven. It's not, the forgiveness of the loan's not taxable. And yet at the same time, they get to claim the deductions on the federal side. But,
yeah, as I said, if you didn't get to claim the deductions, then it's basically, it would be like taxable income to you.
Well, it's
So
like,
I don't think it's double counting. I think it's only counting once.
yeah, it's exempt though, Christie. So it's exempt from income and
So I'm confused. So
tax.
if somebody gives you $100
Yeah,
and you use it to pay an expense, and you're not and you're not subject to tax on that $100, and you're not subject to tax on the expense either, but you also don't get to deduct it. How is that? How has that become taxable income because you didn't get to claim the deduction? You have no revenue.
Well,
So-
normally, if you get $100, the presumption it's income, right? But
Right.
with the PPP, they specifically excluded it from income. Hawaii also adopted that provision to exclude it from income, if it's forgiven, I mean. And Hawaii also said it's not subject to general excise tax if it's forgiven.
Right. All that's described in Seth's document, right? And
Yeah. But what they did just in the recent PPP2 bill is now you get taxpayers on the federal side also get to claim the deduction, even though it's
Right.
exempt from income.
But the state hasn't made a decision on
That's
that
right.
yet.
That's right.
Okay, so past practice, since I'm the oldest member of the council, not the oldest, but the longest serving. I'm sure Jack's older than me. But past practice has always been that we essentially don't forecast tax law changes. And so if we are to follow past practice, we will make our decisions based on current law. And so that would mean that if, I think in this case, we could discuss whether that's a good idea, but we would simply operate under our understanding of existing tax law. So which would mean that we would assume that the state wasn't going to follow the federal rules and change the taxability or the deductibility of those expenses. I think you could argue that we're following state practice by almost always adopting federal changes. That would be an alternative view of this.
That's
Hopefully
correct.
I didn't confuse everybody.
The state generally adopts the federal law so that there's conformity to make the tax preparation easier, and unless there is some overriding reason why the state should be taxing that. And looking at some of the other provisions, I did notice that some of the other states that are offering some of these emergency money to small businesses were allowing them to not bring it into income for the state purposes, I guess so. So I haven't seen anyone yet, because the law is so new, come up with the idea that they would tax this money for the PPP loans to small businesses, but it is a material amount. I think that if you multiply that many billions and there's a tax rate, then it does end up with a lot. But at the same time, the small businesses that received this money felt that this money was just to keep the employees employed and to pay their rent and to keep their doors open. So I'm not sure whether the state would like to take a position and go contrary to what the federal intent of the law was.
So, I mean, this technical discussion is, I'm not sure we'll actually have a resolution of exactly how to account for this. But there's other things going on, and one of them being that tax collections are substantially better than we had originally forecast. And actually, if I recall, that was the argument I made at our September meeting, was that there was no way we were going to get to the kind of decline that we were forecasting. And really, in our September meeting, we essentially forecast that the economy was going to get worse from September all the way to the end of the fiscal year. That's what we assumed. And it's clearly not what has happened. And in fact, the visitor arrivals numbers are all stronger than what we had assumed, what UHERO had assumed when we were doing our forecasting in the third quarter and our forecasting in the fourth quarter by a substantial amount. And, we were assuming, 15, 20% recovery rates for tourism in October, November, December, and we're seeing, 4 or 5 percentage points stronger pent up demand for tourism, and we're seeing much more activity. We also saw substantially more job gains in October, November. Almost 40,000 people went back to work in November alone, if you're looking at the household survey. So I think the economy has been performing substantially better than the council forecast in our last rounds of meetings. And so I think there's also reasons to think that and then the other factors, we haven't talked much about the gains in the stock market and the gains in housing, and the upper end of the income distribution is thriving. It's the bottom of the income distribution that's dying. Maybe I shouldn't use that choice of words, sorry. That's suffering, and and the bulk of the income tax in particular is going to be generated by the upper end of the distribution.
So maybe I can just help you guys move on from this a little bit. When we do the conformity bill, if they choose to include the deduction amount in the conformity bill, our revenue impact will be included in that, right? So they're going to be working off of the budget that you set. And then if they decide to include the deduction, because this is new, then we will include that loss in the future. So that may help you guys out. I guess that's a very backhanded way of saying you don't have to incorporate that in, because if they pass it, that will be incorporated into the law.
So what you mean is you're going to do an estimate of it for the debate on the rule changes or
yes.
the law. Yeah.
Yes, for the deductions.
And then they would incorporate that into their budget planning, is what you're saying.
Yes, we wouldn't, and we're not going to provide a special different estimate as if everything were to be taxed, right? All the PPPs were to be taxed. So that may get you guys settle your minds just a little bit, at least for this issue.
There's a lot of different, because we had so much money coming through, and there was various ways where the government was giving it out to businesses and individuals. We have a lot of situations where, on the regular tax, you'd expect people who receive rent, for example, to have to pick that up as income, and then the landlord also pick it up as income. Although, those are specified now that they're going to exempt the individuals who receive the rent subsidies from having to pay the tax, and have only that being taxed at the landlord level. So, and the biggest one, I think the PPP is probably the largest figures that I've seen on your chart of how much in federal funds. If you multiplied by 6%, isn't that about 300 million or so?
We haven't done a revenue estimate, so I'm not going to come up with that. But again, I do think if you guys include the deductions will be included in the price of the conformity bill, in the revenue estimate for the conformity bill, if they chose to use the deductions. And so that basically means you guys do not have to think about that. In terms of the other things, the fiscal stimulus does feed into the Hawaii economy, and that does create tax revenue, which I think you're alluding to, Marilyn, and you should take that into account.
Do we have an idea set from the second stimulus, the stimulus bill that just recently passed? Do we have an idea how much might be coming into Hawaii?
I have a wonderful presentation for you guys on that. Yeah. So if you want to wait to then, I will give it to you.
When do you want to do the presentation? Before the current year's general fund discussion?
Yep.
Okay.
So right now we're on communication to the council and the public, then we have the minutes, and then we have the general discussion.
Since we have the director available, are we answering your question, Director, from your letter?
No, but that's okay. I understand the methodology you guys are going to use. You're going to keep the CARES impact out of it, and when the conformity bill is passed, then SET's going to do a different pricing on that bill. I think that's a good approach. So yeah, I can wait for the answer. That's great.
I think in past meetings too, I'm not sure if you attended it, but we did go over how much money was coming into the local economy through the federal stimulus bills. Okay. Okay, next item on the agenda is, let me try and pull up my,
Minutes.
okay, minutes, yeah. The minutes from the last personal income meeting. Any comments on the minutes?
I move to approve.
Any
I'll
second?
second.
Okay. Anyone have any comments before we vote? Okay, take a vote. Vice Chair Niwao,
Yes,
Dr. Siderhouse,
Yes.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes.
Councilmember Gluck,
Yes.
and then Scott.
Yes.
Yes. Okay, it's unanimously approved. Okay, next item on the agenda is trying to get
Seth's
my,
show, right?
yeah. Is it yours thing?
Yes. Would you like me to?
Sure,
I'm
why
going
don't
to share my screen then.
Okay.
Do you guys see do you see the big presentation or do you see me?
Yes.
Okay,
Yeah.
you see everything clearly? Okay, good. So I just wanted to start out with where we're at as of this morning. So this is the preliminary. And what it does show is it shows that the general fund is down on the year by 7.2%, which is down here. The general excise tax, this is cumulative for the year compared to the same period last year, is down 22%. Individual income is up. What you'll remember is a lot is it's very hard to think about in terms of the number because of the collection shifts due to the delay in the tax filing deadline. So over here in the orange is corrected for that, right? So I take this money out.
300 million, right, Seth, right?
Yeah, 308 million right here. So it's 308 million. And so when I take that money out, our general fund revenue for this year would be down 16%, right? And then more importantly, you can get an idea of where we'd be with the individual income tax and the corporate income tax as well. Do you guys have any questions about that? Okay. This is the same, slightly, it's from a couple days past, but it's basically the same thing. This is just the month over month, looking at the same exact dates for our December 20th to December 19th. And there's a couple important things to highlight here, right? So the GET had been down in the months of the full shutdown around 25%. And so things are improving more than I would have expected, to be perfectly honest with you. Things are improving here, and I have another slide that shows you the trends, but things are improving for GET collections. Individual income tax is up. One of the big drivers of that is declared estimated taxes. They're up a month over month. This has been a trend across the nation. One of the basic interpretations of this is people, and this goes for businesses too, had not underpaid their estimated taxes at the beginning of the year during the pandemic, and they're making up for it at the end of the year with the last tax payment. And then the other thing is our transient and accommodation tax had been down regularly, down 95%. So we really are seeing that tourism is making a difference in the economy. So that's noteworthy. This is the GET.
I have a question about that.
Yep, of course.
You know, you said the estimated taxes. Didn't we also get quite a bit of estimated taxes that normally should have been made on April 20th and June 20th? We actually, it looked like we got a good chunk of it on July 20th, which is the current fiscal year.
Yeah, but
Correct.
these are month to month.
But however, this is just for the month of December compared to the month of December.
This is just December of 20 versus
So
December
it's
19.
242, okay, I see.
you know what I've been
So
seeing
this
also.
is not a cumulative number.
No,
It's,
this is not. This is a cumulative number right here, and this is why I have a different chart right here, because it's month over month. Carl?
Since we're talking about estimated taxes, one thing that may also, it's very possible could be going on is that people may be taking profits out of the market. And they may actually be anticipating higher tax rates also. And that's, you know, the director asked about behavioral changes, and not only are people saving more, but you know, that savings is gone somewhere. It's gone into housing. It's gone into well, I guess you wouldn't get counted if it went into housing, but it's gone into the stock market, and some of it may very well be coming out.
I think absolutely, I agree with that, because the talk has been that the capital gains and dividend rates are going to double.
I don't know about double, but
that's
certainly going up.
It could be taxed at the ordinary rates.
Yes. Right.
Under the new administration, the proposals were to get rid of the capital gains on the dividends, and also, I guess, raise capital gains rates for some people. Also, I've been seeing a lot of people selling real estate, and people who were owning the property from who are not Hawaii residents had withholdings on their sales of property. So some of that is happening also.
And just as a reminder, that's at the federal level, right? So the federal level will impact behavior. It should not, our rates are, unless our legislature decides to do things, our rates are not intended. We don't expect the federal rates to affect the actual tax rates of Hawaii either, right? So this is just purely behavioral shifts.
Yeah, they basically are having HARPTA taxes withheld also.
Yeah.
But people take action, tax moves before the end of the year. So I agree with Kurt that some people are accelerating their capital gains because of the fear of higher taxes.
Okay, so just go on so you guys can get to your conversation. So this is the GET month over month. So this would be March 20th compared to March 19 was up 5.9%. And so what you saw is you saw this huge decrease in April and May, and then it rebounded when we opened up a little in June, and then it went down. And then over the last 2 months, because what you remember, this should be the lowest month. This is the September when we were actually shut down, right? So as we're moving out in tourism, it's making a substantial substantial impact on GET collections.
And keep in mind that December number is November collections.
Yes.
Excuse me, November activity, and December. So in November, we had about 5,800 visitors per day on average. In December, it was 7,800 or something like that, a couple thousand visitors more per day. It was about 25% of last year's levels compared to about 20% for November.
Because last year was about average of 30 million. I'm sorry, 30,000 a day, right?
No, well, 30,000 is for the whole year. It's an average number of visitors per day, and December would have been much higher than that, right? Yeah. So we're at 25% is almost 8,000 visitors a day. So last December,
it would be
last December would have been
higher than
34,000.
Yeah. So it's probably, I see.
Okay, and then this is just Chairman, the Chair Kawafuchi and Vice Chair Noel asked us to pencil together the impacts of the federal stimulus. This is the most recent federal stimulus, so it's a little harder to parse out than other ones because it's part of an omnibus bill, right? So knowing what's part fiscal stimulus and what's just part of federal fiscal spending was a little challenging, but we got the major parts. In total, we'll see it's about 911 million. The big part of this is here's the federal amounts that are listed in all the newspapers and stuff, and then here's the amount that we've looked and adjusted for Hawaii. The PPP loans, this is the same. I use the same number of PPP or the percentage of PPP loans that Hawaii received as a part that they got from the original CARES Act and the subsequent things. For the stimulus checks, we actually ran our own numbers and made our own estimations based on everybody's tax returns. The UI extension, I checked in with DLIR and looked at like the current claims and how much this is going forward. And then all of these are just basically transfers. So what you'll see in total, this is $3.5 billion that we would anticipate coming from this, the federal stimulus that just passed at the end of September or December, I'm sorry. Again, these are estimates. These are not sure things. However, I think and Carl, you can jump in here, but I checked with Eugene and I checked with Carl, and at least we're all in the same ballpark, I think.
Yeah, we are in the same ballpark for the sort of total. The distribution changes a little bit depending on your assumptions. And
yeah.
The one thing to point out is that, you know, our discussion about what's taxable and what's not, the PPP loans apparently won't be taxable. The stimulus checks aren't taxable. The UI extension is taxable. And then, you know, the other stuff, the almost, you know, 700-800 million in education, healthcare, and other is more nebulous, because that's, you know, much of that. So for example, if the 250 million that's going into education, that's going through the state and could be used to essentially avoid laying off 1,000 teachers or something to that effect, in which case I think it's going to end up being taxable. But it's a little less clear. In our numbers, I would have less in PPP and a little bit larger in the UI extension than the numbers that Seth has. But overall, I think it's pretty reasonable. And a lot of this, I mean, the majority of this we had already built into our forecast for aggregate income that we released at the end of December.
Seth is going to talk about some of the taxability issues, right?
I thought that, what would you like to know about the taxability issue?
Well, I thought you had a slide that kind of summarizes what the status of the taxability issue is.
No, I did not. This is,
oh, okay.
This is a slide, and why don't I just finish this, Jack, and then if you have any questions, you can. This is just all the stimulus added up together, right? And so, you know, as you can see, there was essentially 4 other stimulus bills that got thrown in there. There was the initial one that was about like a medical preparedness, or the first 2, and then there was a CARES Act, which most of us remember, and then there was a follow-in to the PPP. And so in total, that added to about 2.8 trillion. And Hawaii, according to, you know, I've worked with DBED, Eugene at DBED and things, this is about 10.6 billion. If we add in the other 3.5 billion, so we're thinking over a 1-year period, not in the same calendar year or fiscal year, but in a 1-year period, there's going to be over $4.1 billion coming into the state economy.
14.1.
14.1. I'm sorry. Thank you.
And you know what this, of course, what we haven't done is talked about the likelihood of additional support. And you know, with the events of yesterday, the positive events of yesterday, the likelihood of additional federal support in many forms, potentially direct aid to the states, and I think almost certainly support for infrastructure spending in the state, I think is very likely in this fiscal year and next.
Yeah, Carl, you know, I was going to mention that, you know, I agree with you, you know, your assessment of the distribution, because I think, you know, the second round of the PPP, it's adding in additional requirements that weren't there before, as far as, you know, you have to be reducing some of that income, from quarter to quarter, and then, but at the same time, looking at it, I think now with the thought being that they're pushing for a $2,000 stimulus checks, that'll offset that. So I think you're right. I think the distribution may be off, but it's good to hear that. I think that the three of you, I mean, Seth, Yuhiro, and Eugene are all kind of close together as far as the total amount.
Yeah, so this is just what's on the books right now. So what Carl is talking about would be more than the 14.1 billion. This is just, I thought this was really interesting, so I wanted to share it with you. Looks at the income replacement for the different levels of UI benefits and what they do is they wrote this really interesting paper looking at like the types of people who lost their jobs and their average wages. And so if you lose it without with no federal plus up or anything, it's about 60%, 62% of the income. Now, this would not apply to a high income earner, but most high income earners didn't lose their jobs. It's the lower income earners. With the 600, it's about 149%. And with the 300 that were there, it's about 105.5%. So people's wages are being replaced even with the $300 plus up. So that's just something to think about. Again, I always like to end on what your forecast is. Oh, go ahead, Carl.
So one of the reasons that's important is, we talked earlier about the savings, the growing savings rate, and there's, this is really about next fiscal year. Once we have more widespread vaccination, and hopefully by the second half of next year, there's a real possibility that this accumulated savings, right? So if you get enough people vaccinated by the second half of this year, right, or beginning of next fiscal year, to where people are no longer afraid of going out and interacting, so things start to get back to normal. You've got all this pent up demand and accumulated savings, and so if that gets unleashed, there's a possibility that next fiscal year some people, UCLA Anderson is forecasting that California economy is going to boom next year because of this exact issue.
Yeah, and I think, Carl, that's exactly right. And there's a tendency to compare where we're at in like the comeback rates to the last recession. However, the last recession was a financial recession, right? And we're looking at a totally different economic downturn, which is basically we're shutting down the economy for health reasons. And once we take that away, you take your foot all the way off the brake, right? Whereas in 2009, there were so many countervailing forces because people were climbing their way out of debt and bankruptcy that's just not the case here. So most people are expecting a much faster recovery than what occurred in 2009. So that's something to think about in terms of like, don't just take 2009 numbers and transpose them to 2021.
Yeah, I'd like to mention though that this shutdown of the economy due to the pandemic has resulted in a lot of businesses going out of business. And so if you expect that just because tourism comes back, that we're going to bounce back to where we were before, I can tell you a lot of restaurants, a lot of retail stores, and a lot of businesses have shut down for good. And so we're not going to quite have the bounce back to that level that was there because these businesses are not around. I mean, to some extent, we have certain businesses doing very well. The ones who are shipping in goods, like Amazon and the big box stores, they're doing very well from what I see. But the small businesses that we have in Hawaii, they're not, they're either out of business, and so they won't recover to the extent that we were at prior to the pandemic. So it's just a changing of the economy. It's just, whether we can capture the tax revenue from people where we're shipping things in, and people who are sellers from I guess, out of state is another question, right?
No, we do. The number of GET revenues coming from online sales is double from what it was a year ago. So we are capturing that, and I completely acknowledge, and I think that's a great point, Marilyn. However, the other thing you have to think about is if there's huge amounts of demand and diminished supply because everybody went out of business, what happens to hotel rates is they go up a lot, right? So we could even have somewhat inflationary pressures here in the state of Hawaii, at least in the tourism economy, in which case a lot of, at least for the revenue, we would get part of that, right? I mean, completely agree with you, Marilyn. It would be much better to have all the businesses that were here a year ago be here. However, there's going to be a lot of money chasing fewer and fewer things, which could result in the increase in prices, and most of our tax system is set up to capture that.
For GT, but you know, the restaurants, for example, they still have distancing requirements for retail. They have so many people that are allowed in the store. And so it's not like you're gonna, unless we have a situation where everyone is comfortable, everybody got vaccinated, and we have about 80% of the vaccination or people who have gotten COVID, then you wouldn't, you know, we'd have to get to the herd immunity stage where people can feel comfortable with going back to life as it was prior to the pandemic. And I
Agreed.
think maybe
Yeah.
that is gonna not be done until maybe later in the fall or maybe next year. I'm not sure that there's a lot of people seem to be really reluctant to take the vaccination. And so how fast we get there, I think, is dependent upon the vaccination and the herd immunity, you know, whether we can achieve that level.
Yeah. And you guys are the experts, and I will defer to you guys on your assumptions about when the people feel safe. And I just want to end actually with two quick things. One is, this is your forecast, or these are the two forecasts, right? So this is a forecast you had 1 year ago, right? And this is, and then in which case this is the growth forecast, right? So this is 4.1, you had 5.1, 4.14, and then the COVID hit, and you've lowered the forecast. The actual rate is 6.3. And so just as a reminder, the council is on record for a -11 and then a rebound of 8.5, 6.0, and then it decreases with time. So that's where we are. If you could indulge me for just one more second, let's see. What's this going on? I want to share, I sent this out in your packets, and this has been updated, and just so everybody on the line can hear this, all this will be made available on the web. So everybody, the public will have access to all of these documents. But this I made, again, because the amount of changes that we are trying to estimate are extremely high. I made a little model for everybody, and I just wanted to go through the model because I sent it to you, and you guys, this is completely up to you, and you guys can input your assumptions, but I just wanted to highlight how it works, right? So up here is the amount that we got per month. All the ones in blue are historical figures, right? So we have up until December of 2020. The earlier presentation showed that there was $570 million collected in the month of December, right? This, if you look just on month compared to December of last year, we were down only 2.2%, right? So not very much. This is the cumulative, right? So this is what you would expect if you looked at the preliminary number, and this was the year to date over year to date, right? So I showed you 7.2% on the slides earlier. This is what you would see. Now, going forward, these are the assumptions. This is what the month-on-month growth is, and this is what the cumulative month-on-month growth. I didn't I protected all the cells except for these, the ones in blue, in green. And this allows you to assume whatever you want in terms of month over month gains. So what's happening right now is this model is currently making projections given the fact that we think that revenues, general fund revenues will be about 12% down in January and February, 0% in March, and then up April, May, and June. Now, this is only for the normal revenues. I made a different revenue for the income, the shifts that came from the deadline shift, right? And now what you'll remember is there's 308 million difference. Right now I have 5.3% in there because that's the total personal income forecast that you guys had in October. But if you felt like the money should be less and you should be the same, it's pretty easy. You just put 0 and it'll kick out the different numbers. If you think, oh, we're still gonna have a terrible year and it should be negative 30%, you guys just put in negative 30% and it kicks out all the numbers. And so what I wanted to do for you is like, for you guys to look, and now the advantage of this is you can say, okay, if we have negative 30% and we're up 30%, we would expect to get $719 million in the month of April, right? That's compared to, last year was really bad because we were in the midst of the downturn and we deferred all the income. But if you look at the previous year, you can see how you're doing, right? So this just gives you a little check about where you are and doing different things. After this, then I take the same amount out of July in terms of the income shift, because we saw this massive increase in July of 2020 that we don't expect to see in 2021 or 2022. July 2021, the beginning of the fiscal year of 2022. So I adjust that further, but then you can make the adjustment. So when I say 10% up, this is really, you're still quite a bit down on the year because you're 10% up from these really low lows that you saw in April and May. And then down here, you can look at the graph. You can see that what's in orange is fiscal year 2020, and this kind of highlights how bad April, May, and June are. And then all the dotted lines were for fiscal year 21 and fiscal year 22. And the reason I thought this was really useful is, and one of the reasons I like this is doing the cumulative, because we would expect, even though it was really weird for this year, this month in December, the cumulative growth rate moved from 8.2% to 7.2%. So it actually moved up, which was really surprising to me. However, even if you expect things to be down like 15% and down 15% and even down 10%, right? Like what you're saying is you expect this the cumulative number to get worse and then to gradually get better, right? And that's because it reflects what's going on in the last 3 months of the fiscal year. So I just share this with you. It's really hard to do all the numbers in our heads, and I thought we were trying to do this. So this is, you guys are welcome to use it or not welcome to use it, but I just thought I would give this to you. At the very least, you can use it at your desk, and at the very most, you can use it as a point of discussion. Jack?
Seth, what I find particularly useful in this is how the monthly things translate to the fiscal year numbers that you have next to the chart. So, if you're making some decisions about how big the monthly number changes are, you can see how that works out in terms of the annual total amounts.
Correct. And then it'll help you because, fiscal year 2021 and 22 are really hard to figure out in your mind because the changes are so great. And then I just figured you guys could do it on your own for fiscal 23 and beyond.
Okay.
Hey, Jessica?
Well, thank you, Dr. Kobe. I think this is, it's a good tool, very helpful tool for us.
I just wanted to make a note. We need to be careful with July 2022. I don't agree with the formula that's in there. I'm sorry, I caught this really close to when the meeting started, so I didn't get a chance to send you a note. but the way that we're pulling out the year-over-year change, you're actually marking it up 15% and then taking out the original 308.
Yes.
So you're kind of bumping it up by a number that doesn't make sense.
Bumping up
Yeah.
the higher number before you
You're
take
right.
out the.
So you
Oh,
should have taken the 308 out before you layer on that percentage.
Oh,
change.
good point. Yep. I'm sorry about that.
Yeah,
I can fix that right now, actually.
Prior year, right, in 21.
Hmm.
So, you know,
If I could ask,
2020, July 2021 and July 2022 should be pretty stable, except for any growth.
so
if I could ask a question,
Yeah.
Seth. First of all, once you fix it all, if you could send that out again, then because I think you changed the totals for December too, right?
Yeah.
But just to clarify, when you say month over month, you mean month over a year ago month,
Yes.
as opposed to last month over this
Yes.
month?
Yes. So just
It
so
means year over
like
year.
April, right now, under these assumptions, we're saying that May will be up 33.9% relative to in May 2021 relative to May 2020.
Okay, thank you for that clarification.
Yeah, thanks for checking that. Checking that, Jessica.
So, you know, one of the things that this is what we were trying to do last meeting on the fly, right?
Yeah.
And it really makes the point that we discussed quite a bit last meeting, was that there's no way you can get to the economy has to just completely fall apart for the rest of the year and deteriorate in order for us to get to our forecast. And so even if you assumed that, you know, for January, February, March, that we were down by 16%, which is what the adjusted numbers are year to date, right? So you could even assume
Right.
worse than that, because once you get to April, we're making that comparison to, you know, to the shutdown period. You just can't get to the minus 11%. That might be too strong of a statement, but I mean, there is a, you know, if we were to see the virus spread rampantly in Hawaii and we shut down completely for the rest of the fiscal year, yeah, you could get to that, but I don't think that's what we're talking about.
Yeah, well, just to go, like, we could see what you would need to do to get to 11%. That's what I think is so cool. So you would basically need really bad, it would need to be worse than lockdown numbers. And even if we're worse than lockdown numbers from the previous thing, and things would have to be worse than last year.
So the second piece of it, we have two items, right? We're coming off a super low number for April, May, June. So we're starting at a low base, but we're also expecting that we're going to have tax returns due in a regular time frame. So we're expecting that we have those tax payments. So that's the other piece, that unless that number goes negative this year or we somehow get extended out again, yeah, it's very difficult to hit negative 11.
It depends upon how many businesses have gone belly up, and, you know, as far as how much we considered as income last year, because some people have lost a lot of money. And the other thing is, if you look at the West Coast, the virus, they have shutdowns now, because I keep wanting to get over to the West Coast. They have, you know, stay-at-home orders, and they're keeping this going on. They're not getting out of it. So I'm not sure we've gotten over the virus problems for this fiscal year, just because if you look at our market, they're having big problems controlling the virus.
So that you're absolutely correct, Marilyn. They are having big problems. They were also having really big problems in December and in November, and you know, and yet I mean, I'm surprised at the number of visitors that we've seen in the islands, and I guess I would be more worried about another, you know, spread of cases here as causing a shutdown. But even having said all that, what Seth just showed us was that things would have to get worse here for the most of the next several months than they were at the worst of it in April when we were completely shut down in order for us to get to 11%.
Yeah,
And by the way, Christy, I sent it to you, so you guys should have the model. Thank you.
I've got it. Thank you.
Good.
yeah, I looked at the numbers, the daily figures for how many visitors are coming in to Oahu versus Maui versus Big Island versus Kauai. And it seems like, Maui is, and the neighbor islands are higher as far as the visitor count than Oahu.
Yep.
And I understand that's probably because the Japan tourists, it's not happening because of the fact that when they go back to Japan, they have to quarantine for 14 days or 10 days or whatever it is. So for Oahu, I'm not sure that you'll get the same kind of visitor count that you expected, because that's where a lot of the visitors come and spend a lot more. And for the neighbor islands, so we are doing better, I think, than what Oahu has been previously experiencing.
So just to be clear, the visitors spend more on Maui than any other island. And I understand that there's a lot of businesses that are shut down, but you're right. Maui has actually been outperforming Oahu, and some of that's also will likely start to change now that we've got Canadian flights coming in. So we had, I can't remember the number, but the Canadian flights started up in December. There were several Canadian flights that started back up, and many more are scheduled to fly in the month of January. But look, any way you cut it, even if we stayed completely static on our recovery, which is what we're assuming in our forecast right now, is that basically where we got in December, we're actually going to back off of that a little bit in January, February, and March, partly because of concerns over the virus on the mainland and ability to get tests and so on. But even if, as long as we don't go into another shutdown, if we just stay where we are, there is no way you can get to a minus 11%.
I was looking at these numbers, and
I'm sorry to interrupt, but Chairman Kawafuchi, do you want to move on to the actual discussion?
Yeah,
because
let's move on. Let's move on. We actually already bled over it.
Yeah, it's that. And let me know if you want to take this down or leave it up. It's totally up to your discretion.
I have to leave it up for a bit.
Okay.
Well, would you like to leave it up?
I would.
Okay,
I'd like to talk about the forecast for fiscal 21.
Okay. Okay, so we're into, we've concluded Dr. Kobe's discussion where we start discussing the current year's forecast. So please go ahead.
Well, the numbers that we have up right now translate into what, negative 1.2% for 2021? And what would that be without the transfer in the beginning of the year, or the timing boost?
What do you mean by that? If there was no transfer,
yeah,
it would be like that.
So if they're basically negative 6.
Yeah.
Okay.
So, if we average what we're averaging in November and December for the rest of the year, what would we end up with?
With the November and December, that's like about negative, let's say that -7. It's a little bit.
Well, November, December, if you
November, December wasn't that big, right?
Well, it was negative. It was down -6.8 and not -2. So would you like me to put in
so
-5?
You average that out as -4. So make it -5.
Okay.
And
then what do you guys want to do in March? Because March is like the first year. It's kind of an iffy thing because it hits. So if you look at like
March,
we were down 60 million.
Yeah, we're going to get the estimated taxes in April, right? April and June.
Yeah.
I just wanted to see before we factor that in, what would we end up with?
Well, Kurt, If you look at
Yes,
the
yes.
monthly collections and you look at December and say where we are, positive, we had a whole bunch of money coming in for estimated taxes in the month of December, 56% additional. And, you know, if you're trying to extrapolate from December and saying, okay, we're going to have this kind of estimated taxes come in the later month, I don't think that that's going to end up being correct. Because just because people are paying in December of 2020 versus December of 2019 and a 56% increase, you know, if you looked at the monthly detail of where we're receiving the revenue, I don't think that we're you know, it's going to be that way next month. You know, usually it reverses.
Well,
January
what do you think?
very
What do you
big
think
month
it should
because
be?
of the December
Yeah, take
December
a look
holiday
at December.
season. So January is usually a really big month historically.
It's just that we're quite a bit up for estimated taxes for individuals. And the
So
G
if you
tax is
completely
still,
take out the surge in estimated taxes, right? So if you, instead of assuming what we saw, well, instead of taking a growth rate based on the roughly 20 million in extra declared estimated taxes, you know, it takes several percentage points off the growth for the general fund. Right, take 20 million out of that, you get, so December 20 would be 500 million compared to 594 million the previous year. So instead of -11, you'd be at like -14, or -12, you'd be at about -14.
So Sid, what did we end up with? And
Correction, -16.
-4 for the
I'm
rest
sorry?
of, if we averaged -4 for the last 6 months, what would we end up at?
You want
Before adjusting
-4?
for immediate taxes and payments, you know, with the return.
What do you guys want to do for April, May, and June? Because this is compared to the previous
Yeah, I
year.
just
Should
wanted
it
to
be
see
up?
if, I'm going to make the other adjustment after, but I wanted
Oh,
to see
okay.
if it was like -4 generally for the rest of the
So
year. Then we adjust for
You
the
just copy the
estimated
-4 over.
payments with the extension in April, as well as the estimated payments in June.
So where did you come up with -4?
-4 was the average of November, December.
Okay.
And so April of 2021 is going to be worse than April of 2020. That's what you're saying.
well, right now this is, don't worry about the tax transfer because I took that out, right? Because if you guys think people are going to bring in, the way that I look at this is, if you're worried that we're going to receive less tax payments than last year, then this should be minus. If it's the same, you should just leave it as is. This number is basically, you can think about it as like the GET and the TAT,
Right.
right? So if you think it's going to be only
How do you
10%
get
better than
the
April,
positive 10% in May?
what's that?
How do you get the positive 10% in May?
Oh, well, I just put it in because I was like, it has to be better than last April, right? So
Yeah,
if you
but
kind
I
of think
mean,
about this, so in
mostly in
2019,
April, right? And then it's, the profits are going to be way down for companies.
yeah, profits are going to be down. And so people
okay,
are
so
not
you want to,
paying-
let's say that if you want to say the profits are going to be down even 50%, right? Then that's what you do. And then this is more for, think about this more for economic activity, and think about
So-
this number
you
more for
didn't-
like individual income tax. That's what I would think. And the big caveat is this is on top of what we received, right? So this is only the transfer. So we did receive more than $308 million in individual income tax payments. This is just what shifted. So you could actually say that take all of this out, right?
So what do we end up with at, is it almost -3?
Yeah.
If you had if you didn't, if you expected $308 million less of payments and estimated taxes compared to the year before.
So have you carved out, or are you including the
I-
July, the 308 million from July of
No, this is what I did. So like I took
This is
this
what?
out of July and I put it back into April and May.
Oh, you already put it back in.
Yeah. So 0 means the payments are going to be the same over, you know, between for 2020 and 2021. The income payments will be the same.
I think that from what I see, a lot of people didn't do very well, you know, this past year. So you're not going to have as much income coming in April that you normally would have in 2019.
Yeah, that seems too high to be at that level.
So do you want me to?
Because you're going, for example, in April, you're saying this April will be 775,000, or you change it to 682.
I'm just, you guys got to be the drivers. I'm the
So
I'm the
what are
bus
we in the
driver. You
talk
guys
right
tell
now,
me where
sir?
to go.
Because you
But
keep moving around.
sorry.
Well, I think maybe we ought to approach the discussion from a different angle, which is basically what Carl was trying to do earlier, which is, you know, at no reasonable scenario for January through June are we going to be at 11%, negative 11%.
Yeah,
So then the question becomes, okay, if it's not negative
these
11%,
numbers,
then
yeah, I think
where are we going to be?
yeah, June looks too high in this chart.
It depends upon how much income everybody has, but a lot of people didn't collect rent this last year. A lot of people didn't collect a lot of money this year. So
yeah, I think that the income's going to be, it's not going to be at the 19 level because we have too much, I think we have too much unemployment, too much
Except measured income,
restaurants.
measured income is rising.
Carl, excuse me. You know, we have too many restaurants and hotels that haven't been at capacity. I don't think we're going to have the same income base.
So it sounds to me like you're talking about corporate income, which
Right.
is a tiny piece of the tax revenue picture.
No, I'm not talking about corporate. I'm talking about all income for either people working, like employees, or people, you know, small business people, as well as corporate people.
Well, all the numbers that I see for March and April and May and June for fiscal 2021 are all substantially below the numbers I see for that same period in 2020.
Yeah, June is a little bit high, I think.
Oh, no, I'm sorry,
We can adjust-
especially 2019. I mean, you
Yeah,
know, if you take 2019 as kind of a normal base for what our
Yeah.
economy does,
Yeah.
well, which may not be relevant anymore, but you know, 2019 at least is not COVID affected.
Yeah.
And you look at our 2021 numbers, we're dealing with substantial reductions. I mean, that's what we're.
The other way to look at it is you guys can look at the graph too, if you want.
Because what's our Hawaii's unemployment now? What's the percentage? I know nationally it's about
1%.
Yeah.
Our withholding, to be
Yeah,
fair,
but
our withholding is only down
disconnect.
3% on 5% on the year.
Yeah.
There's a
But
complete
there's just so many
disconnect
businesses,
between,
you know, people that haven't been working, and so many businesses that aren't at the same level or have closed down.
there's a complete disconnect between unemployment and income because of the federal support, right? So, and all of the UI benefits are taxable. I mean,
So I can see, you know, they're going to owe it in April. Next April, a lot of these people going to have to pay income tax.
Yeah, 33% of the people who are receiving UI have elected to deduct income or taxes.
They're having withholding.
33% of the people
So about
receiving
2/3
UI.
still have to pay it then in April.
I think the problem that you'll have is basically in the businesses that won't have the kind of income, and people who have S corporations or Schedule C businesses, or people who even are renting out property, they're not going to have the income that they had in prior year. There's a lot of rent that was deferred, so people aren't going to be reporting as much rent. So it's a really divided economy. You have people who are state and local employees who are still receiving their regular wages, so they're not feeling the effect as much. Then you have people on unemployment. Some of them who've gotten federal stimulus are going to be okay. And so I think that you're going to have what we're going to see is a lot of the businesses, people who have businesses aren't going to have the kind of income. And a lot of them have traditionally in the past have higher income. All of a sudden that higher income is not going to be there. And similarly, if you look at the GET and the TAT, TAT is down what, 70%, and GET is down so about 15%. And that is where you're collecting the money, the GET and the TAT. I can understand about income tax that we're going to still have some money being paid in from the people who are unemployed who didn't pay withholdings, but you're going to still have the problem of businesses who are going to either be out of businesses or who have losses, substantial losses. And you're going to have transient accommodations. The hotels here, maybe they're charging higher amounts, but they're telling me that their occupancy rate is like about 20%. So I understand about the hotel room rates here, but I recently went and looked online to see what happened to the rates after, currently. And the rates have dropped significantly, the room rates.
So since we're talking about the mix of revenue sources, in terms of individual income tax collections, the bulk of that is withholding on wages. And there's the 200 in most recent the cumulative totals, roughly $1 billion out of the 1.5 billion is withholding on wages. And so even if the other components are down, we're not seeing the kind of income losses that we're trying to assume. What Marilyn is telling us is that, okay, come April, we're going to see those. I think that's what she's saying. I said, businesses aren't going to be able to pay taxes because they won't have had any income or any revenue. But at the same time, roughly 2/3 of income tax collections are not only stable, but likely to continue to grow as we go forward into the second half of the fiscal year.
Do you know why that's the case, Carl? I mean, if we have such a high unemployment rate, why is our withholding not withholding not decreased so much? Or at least kind of proportionately.
So there's a whole variety of reasons, but one of them is that the people who lost their jobs were the lowest end of the income distribution. You're talking service workers, and many of them may have also been part-time jobs, and so you can have a disproportionate. So think about it this way: if you have 4 people making $25,000 a year who all lose their jobs, but one person who's making $100,000 a year gets a bonus, they can offset each other, and you can end up with stable income despite the fact that you have high unemployment.
Would the difference be that great between unemployment and the decrease?
Well, it is.
Well, apparently.
We have a a relatively progressive tax structure here in Hawaii, right? So if you're making less than $30,000 or $40,000, your tax liability is much lower than somebody who's making $150,000. And that ends up making I think that makes a big deal in terms of what we're seeing in terms of withholding and things like that.
I think that when I looked at the income tax charts and who's paying the most taxes, I guess there was a distribution that the tax department had regarding who's paying the taxes. The bulk of it was people who are earning like 200,000, 300,000. There's a lot in that area, and there's a lot of small business owners who also fall within that category. So that's why I'm thinking that a lot of the income tax, when it comes April 15th, you know, you won't have the kinds of income that you had before, except for the exception I say is people who sold stock or real estate. I think that,
So what's the number going to be? It's not going to be minus 11. I mean,
Marilyn, if one way to
so the forecast that I get out of my model, and I don't mean the model that I submit to I don't mean the Department of Taxation model. I mean UHERO's general fund forecasting model. I get something like -7, and I actually think that's a pretty reasonable number. I don't think we're going to end up at -2 or 3. I think that's. I mean, I agree with Marilyn and Kurt that there are issues about small business revenue and you know, people who are renting properties that aren't getting rent. But I also think there's just no way we're going to get to a -11.
Marilyn, one way to think about it, just real quick this number is the difference between last year and this year, right? So if you really think that we're going to make $300 million less, you can just play with this on your, or this is $600 million less, right? But if you wanted to say 50%, if you really think that they're going to make $300 million less compared to last year, you just plug it in and this is the amount you can deduct and you can add that in there.
assume that we are going to not tax the PPP deductions that is now non-taxable for federal purposes. What kind of numbers would we be looking at? I mean, what kind of percentage difference in what kind of percentage difference would we be looking at as far as the growth, general fund growth rate?
Again, I would caution you against including that in because you guys are going to set the baseline and then my office will come up with the revenue estimate for that. And then we're going to subtract that from the baseline, right? If they were to include the deductions, if we were to follow the IRS and the deductions, we would be subtracting that out. So I would encourage you not to incorporate that and just come up with a baseline for that, because any additional legislation will be added or subtracted to the baseline that the council is providing.
The letter to the governor should clearly state that, right?
Yeah.
In other words, we're going to assume that it's going to be taxable. Is that what you're saying?
I'm saying you should assume that all the tax laws that existed previous to December 26th, right? So the only thing that you should not consider is that they can, you know, there's this discussion whether they can claim the deductions against the PPP or they cannot. I would suggest you not incorporate that because any conformity bill would have that revenue impact statement associated with that, if that's what the conformity bill were to choose to do.
Yeah, normally conformity will just pick up whatever the federal has.
But conformity bill has a revenue estimate established, attached to it, right? So if they rate the conformity bill exactly like the IRS, they will have to take into account the revenue impact of conforming to the state. Because currently we do not, Hawaii's legislation does not conform to the IRS. We have to do it on a yearly basis.
I personally like Carl's estimate. I would agree that, especially where we are today, it would be very difficult to get to that rather pessimistic forecast that we had put forth earlier. And I've been pleasantly surprised, as Carl mentioned, in how much the GET and the TAT have recovered. I mean, they're still down substantially, but things are looking up, and perhaps I'm being too optimistic, but I do think that that things are looking better. We do have to keep in mind that we may end up, especially after today's numbers, kind of scary COVID numbers today, that we may have another shutdown. I mean, it's being recommended that no gatherings happen for the next 14 days. That sounds very familiar, like what we had back in March. And I'm hoping that we don't actually have a shutdown of the economy. But I've been pleasantly surprised by the most recent numbers.
Can I ask a question of the state tax director? Where is, I'm not sure. Is
Director Choi watching?
Is he here?
Yes.
Yes, he answered.
Yeah, I just wanted to ask what efforts, what is being done to try to collect from your accounts receivable, and what compliance efforts are being made by the state to try to shore up the revenue sources?
That's a good question. So ever since I've been here, I've been monitoring the accounts receivable for dole tax on a monthly basis. And in fact, I just got a report this morning. We're about $1.1 billion in receivables. Your question is how the collection, the accounts receivable seems to be a little bit stable right now, but I do assume that it's going to go up once people start filing for the year 2020. Your question is, how are we protecting the revenues? You know, we're increasing our efforts in liens, maybe not necessarily levies, but we're going to try to perfect that claim against the individual, and hopefully in the out years we could eventually collect it all. Did I answer your question?
So you're talking about the current amount that would come due, or are you talking about the past due accounts receivable?
I'm talking about total accounts receivables, about $1.1 billion.
Do you have any lawsuits that you're monitoring where the state might collect more money than expected?
I mean, we do have lawsuits outstanding, but nothing out of the usual. It's pretty usual, the usual amount.
That would affect this current year income.
But I do expect receivables to increase when the filing seasons begin.
I think he's going to collect a lot more money, Marilyn, even in this economy. And the department will collect a lot more. That's my, based on my experience. Just a more, just being much more vigilant and being more willing to, agree on reasonable deals rather than trying to collect every single penny. Because I think when you have a really hard line position, you do collect some money, but a lot of people, it's hard to get the people to agree to pay it when it's a really hard line, if they want every last cent.
So if I can try and help us to reach some kind of resolution on the current fiscal year, to give you an idea of how you might get to a number close to 7%. So leave the 100 minus 100% in the income tax, since there seems to be, there's certainly some concern about small business tax revenue for this year, and then take January, February, and March and just make them minus 10%, and then make April, May, and June 0.
Okay. What's going to happen if that's the situation?
That's why he's plugging
What he's doing right now.
Okay, so
minus 6.5.
So the minus 10 is, not that different than where we are year to date. I think we're at minus 11 year to date, and minus 10 is worse than what we've seen in November, December. And that's fine because we saw the surge in estimated taxes in December. If you want to make it even worse, make it -11. You still won't get to -11%, right? So this is a really pessimistic. This says no improvement year over year for April, May, and June, even though that's the worst of the shutdown. And that's just, is sort of agreeing that there's some real uncertainty about income tax collections in at the end of this fiscal year. So you still get to only -6.5.
And Carl, am I looking at this correctly or thinking about this correctly? I mean, with that negative 100%, so basically removing the $308 million in tax revenue, and that is tax revenue, right, Seth? That translates, I mean, if you were to use just an 8% tax rate, I mean, that's like almost $4 billion of income that's wiped out. Am I looking at that correctly?
Well, and so that's that's the non-taxable PPP money. Right. I mean, you add up all the PPP money from the previous two programs and the new one, you probably get to a number like 3.5 billion. And so that's in. So one of the reasons I'm doing that is because at least in our models that income would be taxable, right, historically. And I'm just trying to show you how pessimistic even a -7% number is. That's really all I'm trying to do. Mm-hmm. Obviously, I don't know what the number is going to be.
Can I just add that for January and February, these assumptions have January and February revenues for fiscal 21 greater than the same periods in fiscal 2019.
So there's room for it to be more negative.
Yeah, I think there's room for it to be a little bit more negative for January and February in particular.
Yeah.
So, can you put in -15 for both of those 2 months?
So that's what I was doing in my own version of the spreadsheet, but I wasn't assuming -100% in the income tax adjustment, right? So when I first started playing with this, I was using -15 for those 3 months.
Mm-hmm.
There's one more for March.
No, I didn't want to do March because it's hugely below 2019 already, and 2020. Okay, and that's -7.5. So I'm good with anything that's -7.7, anywhere between -7 and 7.8. Excuse me, -7 and -8.
Okay, how about if
How do you feel about -8?
-8 sounds better to me, but so we have to do it with an assumption that the PPP deductions will not be allowed for those who receive PPP funds, because that's a material amount.
Oh, we've had that discussion already. I mean, isn't Seth going to take care of that?
Well, as a director,
that's not. It's not our job to assume tax law changes that haven't happened.
Yeah. Yeah, historically we haven't.
I mean, the only thing that really matters is that what our assumptions are and our results are clear. And I think they are.
I hate to kind of put it so that there's an assumption that the PPP deductions won't be allowed, because
that's not the assumption. The assumption is that we're following current tax law.
The current tax law basically allows for the deductions to be made for those who receive PPP funds.
That's only on a federal level, though. I mean, the conformity law has not been passed, Maryland. So under current Hawaii law, without that conformity bill, we have to assume that the deductions are not allowed. So it's effectively that it's taxable.
Okay, but there's a lot of other provisions for the amounts that came in CARES. Besides,
But our problem is that if we start doing that, where do we stop? Which changes do we adopt and which changes don't we adopt? We just don't know. And that's why we do it the way we do.
Yeah, and I think that's
we've always done it that way.
that's a point I think that Seth and was trying to make, is that he's, when it goes before the legislature, if they want to make that adjustment, that conformity, then he will provide them with the data that they can determine what the impact of that, of making that change, that conformity bill will be, and what components of that conformity bill will be. So he's going to provide them with the ultimate cost of it, and then they will determine what they want to pass or not.
Then I would suggest that they actually add in a lot of the other amounts that came in through the CARES Act and put a price tag on everything. In other words, we assume that, everything is taxable, and here's a cost for everything. And then the legislators can decide on that, because I'd hate to isolate only small businesses and have them bear the brunt of the burden of this tax, of having to make up the taxes.
Yeah, but I think that's what we're doing, right? We're under the current law, where we're determining what the impact, what we believe the forecast is going to be for the general fund. And then the legislature will go back to Seth and say what potential federal changes they may want to adopt. And then Seth will have to calculate those numbers, those adjustments, and then they'll determine which ones of those pieces they want to choose. I think that's how it works.
Yeah, I think even the stimulus money that comes to everyone, to me, that's the legislators, the feds have indicated that's non-taxable. But, you'd have to go down each of the provisions and say, okay, this one costs this much, this one costs this much, and all that. The PPP is a large number, so that's why I can understand taking that out. But there are other provisions, as far as what the legislators can do to raise some money. I just don't want them to pick on small businesses, because from what I've seen, the small businesses have really needed that money, and I don't think they expect to pay any taxes. The good thing is that the state income taxes are a lot less than the federal taxes. And also, if it's not taxable for GET, then that's helpful too.
What you're really talking about is you're sort of hoping that the legislature will behave in a certain way, right? This is not in our purview. It's not what we're charged with, and I don't disagree with you, but I think it's beyond the scope of this conversation.
Okay, then we can make a assumption that this is the rate there is, assuming that there's no deductions for the PPP.
No, we're making an assumption that we're following existing tax law in the state of Hawaii. Period.
I think it's unprecedented that small businesses get this kind of grants. So I'm not sure that there's a state tax law that deals with this.
Councilmember Glucker, what is your view?
Well, so Hawaii did, conform with the original CARES bill, right? We already have the guidance that came out from the stimulus and everything that happened earlier last year. And
we partially did conform, like with respect to, we conformed with respect to the PPP loans.
Right.
Yeah, but we didn't conform to all the other incentives, like the 5 net operating loss carryback, etc.
Right. So we have the model that we're already doing, where we're not taxing the grant as taxable income, right? When the loan is canceled, and we're not allowing the deduction. So I think following the current law makes sense until additional laws are made and we actually conform to any federal changes that just came out last week. I don't think it makes sense for us to try to decide whether or not that's going to happen in the future.
What is your view on the current year revenue?
I think -7 is a reasonable number. You know, I think playing around, we're not trying to nail down what each month will be. And so January, I think my numbers are lower in January and February than some of the models that we were doing. But again, the math kind of moves around if you lower some months, but I don't think that we'll not collect any payments on taxes when the tax returns are due. So I don't think it'll be -100%. And so I think even just running through different models, I think -7 is a pretty reasonable number.
Councilmember Hayashi, what is your view of the current year's revenue?
So I think 7 is probably the worst case scenario. I mean, what I'm looking at here, I mean, so this removing $308 million worth of revenue basically means that factors in potentially, you know, about $4 billion worth of income loss. So that would address the potential loss of businesses, you know, and other types of stuff in that nature. This is also assuming that there is zero growth in April, May, and June, which we know, I mean, unless we're shut down again in those months, there's got to be something higher than that. So that's why in my mind, I think, you know, it's got to be higher than 7. 7 is probably our worst case scenario. And you know, that's why I think our mean forecast for the council was 6. So I'd throw that out as a potential number at 6%, which is still, I think, relatively low. A -6. I think it may not be that bad when it's all said and done.
Okay, thank you.
Where'd you get 6?
I believe that was the information. That's the mean forecast, isn't it, Seth?
Yeah, -5.8.
I mean, if you look at the chart 6AA, table 6AA, it's not -6.
If you look at the mean forecast summary.
Yeah.
And you do model 1 for fiscal year 2021, it's -5.8.
Am I missing something? For table 6AA, results from model 1.
No, if you look at
No,
the,
it's a separate.
the summary of the members' forecast.
What page?
It's the separate
It's a
attachment.
separate document.
Oh, okay.
What's it called? Summary?
Summary of members' forecasts.
I think the file is called forecast distribution.
Oh, forecast.
Oh, yeah,
distribution.
forecast
Thank you.
distribution.
We have to actually look at it below the line, right? Wow.
You do below the line, yes.
So isn't it -13?
No, it's the mean forecast is -5.8 on the, and that's when we take all your forecasts and we add them together. We create the mean and then we input that into the model.
Seth, can I ask a question? So it's a bit technical, and I hate to divert the discussion in that direction, but there's one thing I saw on my forecast that had the TAT zeroed out for fiscal 2021. And I was wondering what was happening.
Oh, that is because right now the governor has made a proclamation that all of the TAT revenue goes directly into the general fund. Normally 203 million of which goes to special funds, including the counties. And since that has been ceased, we did that. And under the current forecast, the TAT is less than the 203 million, and we couldn't have a negative amount going into the general fund.
Okay, all right, thank you.
So I agree with Scott that you know, I know I threw out the -7, and I threw it out just because that was what was coming out of my model, and because I'm sort of adamant that -11 is way off the mark. But I think -7 is probably very close to worst case. I think it's going to be hard to get to -7.
So we are right
I'm
now,
okay with -6 also.
we're right now at -7.2.
No, we're at
Year to date,
-11.
No, the
year to
actual
date, actual.
7.2.
Oh,
Is that right?
right, through December.
Yes. And I would like to remind you, we expect in the January, February, March things to get worse. And then because we're coming off such bad numbers in April, May, June, to really go back up. So if you look at this number, even with I mean, 000 is a very pessimistic scenario, right? And you're also assuming that they're losing all that income. So, but even then you start really seeing the rebound in April, May, and June.
So you, at the end of June, you have 7.5?
Under these scenarios.
Yeah, it's a very pessimistic scenario. I mean, the one I was running locally was assuming the 30% drop in the income tax adjustment, and then 15, 15, 15 loss, and then 0, 0, 0, and I get 4.6%. I mean, I think, yeah, it's hard. I mean, right? But the 0, 0, 0 is extremely pessimistic.
Mm-hmm.
And I mean, I was trying to do that. I was trying to get everybody to realize how pessimistic we're being.
Well, again, it assumes that everybody's income is going to be a lot greater, but I think that I'll be happy with -7, assuming that we are taking a divergent position by having the PPP deductions not allowed. I mean, if we put that in our forecast figure as an assumption.
Just another comparison is like right now with 0% growth, you're assuming that April and May which are traditionally our best months, are worse than December. This month's collections.
Yeah.
Well, as I said, that's when the income taxes are paid. And
Seth, can you scroll so you can see the graph?
Yep.
Marilyn, you're okay with -7?
big pardon?
You're okay with -7, but
As long as we put down that it takes a viewpoint that the PPP deductions are not going to be allowed, that are allowed by the most recent federal tax law that passed.
Well, can't we just do that by saying we await the conforming, or this is without any conforming legislation using current law, including the PPP thing?
yeah, how does all the members feel about that?
When there
We've
was
been talking about this for the last 2 hours, and it doesn't seem like we're getting any closer. We keep going around and around on the same subject. And
Yeah, I think that we have to put that down, though. I'm not sure what was included in the conformity for getting the PPP non-taxable for the state, because there's legislation that said the PPP funds are not taxable. It just didn't go to the point of saying that the deductions would be allowable.
So Marilyn, let me get to, let me cut you off there real quick, but Seth sent out the TIR 2020-06, which talks about the tax treatment of all of this stuff. Isaac wrote this back in October. Director Choi wrote this back in October, which talks about the Hawaii tax treatment of all of these types of payments. So that's what we're kind of conforming to, is the current state of law under TIR 2020-06.
Okay, I see. So you're gonna, even if the current law right now is different from what the state has, we're gonna just.
Well, this is a current
federal
law. yeah, the federal law may be different, but that doesn't apply to us right now. Right now, the state of law is this 2020-06.
Okay.
So where are we? I think we have we have an agreement on the percentage, but don't you think
No, we don't. No, 6 and 7 are both in play.
So I'll move that we adopt -6 for fiscal year 2021.
I second.
Okay. Any discussion? Any further discussion on -6? Marilyn, you don't want to discuss -6?
Me?
We're about to take a vote on -6. What?
I guess I'd be comfortable with -7, just because I've seen a lot of people suffering, not having income from the rental, not having income from their businesses. And I think that, when you're looking at the income for small businesses and people who have property and all that, you're not taking into consideration that people are going to file for net operating loss carrybacks to try to get past taxes that were paid and get them refunded. So, it's not like you can go along and ignore the net operating losses. I think there were going to be some net operating losses.
But we said the NOLs are only carrying forward. You cannot file for a refund for prior years, but it will impact in the future taxes that you pay.
Why are you saying that you can't carry back?
That's current.
Not for Hawaii law.
I think in Hawaii you can carry back.
I-
You just can't carry back 5 years. That's the current federal law. But I believe you can carry back 2.
I'd have to check. Because can we still carry back after?
I didn't think so. I didn't think after the 2017 law, but I would have to double check.
Would we feel,
Before the CARES Act, that you could only carry forward, not back.
Yeah, I thought that Hawaii adopted that. I mean, for me, it's the uncertainty and also the high numbers today. And we're kind of assuming things are going to kind of start returning to normal without any hiccups. And I don't know if I'm that comfortable.
That's not what we're assuming, Kurt. I mean,
well, what are you assuming? I mean,
these assumptions don't involve any improvement in the economy at all. So, we're talking about -15 for the next 3 months, and then no gains year over year. And actually, if you look at the graph of what we're assuming for tax revenues, it's no gains over what was a horrible period last year. That's not it. That's not returning to normal.
would we be comfortable compromising at 6.5? I think we started out, Jack thought 7 to 8, -7 to 8.
yeah,
Carl thought -7.
yeah.
So
Then we moved down.
I'm just throwing that out there to further the discussion.
Yeah.
I guess I wasn't quite sure why you're saying there's no carryback of net operating losses.
There is on the federal side, but not, I think in the 2017 law, they stopped the carrybacks on the
Yes.
federal side. And I think Hawaii conformed to that.
Yes.
Yeah.
So Hawaii Revenue Statute 235-2.4N. Hawaii does not allow any carrybacks, indefinite carry forward.
Okay, and to change the federal law that allows the carrybacks.
We did not conform.
So it was my motion, and
My second.
it's 4 o'clock, and we still haven't done fiscal 21. Always seems, we keep rehashing the same issues over and over and over. We've got to reach a resolution on fiscal 21 so we can move on to the next fiscal year. So yeah, I mean, look, the difference between 6 and 6.5, it's the same old story. Is we're really talking about something that's completely unknowable. I mean, our error bands on this forecast are probably plus or minus 2 or 3%. Obviously, I mean, we were at minus 11 in September, right? I mean, so yeah, I'm in the interest of moving forwards. I'm willing to do 6.5. I don't know if Jack will. He's a little more
Well,
hard.
7, so I'm willing to do 6.5 too. And I share your feeling about the length of time.
Okay.
Marilyn, where do you?
I was,
We can carry
7,
that forward.
but I'll be willing to go down to 6.5 to expedite decision.
Okay, any further discussion?
Was that an official motion, Carl?
Yeah, we need a motion.
Yes, I
We
move
need a second.
6.5.
And
I
I'll
will
change.
second that.
Okay, second. Okay, take a vote. Vice Chair Niwa,
Yes, assuming this assumption is made.
Dr. Siderhouse,
Yes.
Dr. Bono,
Yes.
Councilmember Maynard,
Yes,
Councilmember Glucker,
Yes.
Councilmember Hayashi.
Yes.
Okay, so it's unanimous at 6.5%. Okay, next item is fiscal year 2022. Jack, Carl, you want to start us off?
I just adjusted it to negative 6.5, so you guys have something to do when you're looking at 2021 or 2022. I'm sorry.
Well, my forecast, my input to the model has me at model 1 is 7.5, another one, model 2 is 5.6, and then the single equation model is hugely different. It's 25%. So I'm kind of at a loss at this point. You know, there's going to be a recovery. The recovery is going to be substantial. I think it's probably, it's probably going to be bigger than 7%. It could well be a double-digit recovery. But we're recovering from a low base. So it's, while the percentage looks good, the amount is not going to be as much.
So, Jack, what was your number for fiscal 21 in the tax department's models?
Negative 4.8. So it was a pretty decent outcome.
So in principle, then you would expect even a little bit higher growth since we're pulling the fiscal year 21 number down with our subjective adjustments.
Right.
We're fiscal 21. We're going from 11 to 6.5, right? So we're increasing the growth by 4.5 points. So the base goes up for fiscal 21.
Yeah. Yeah, but I was just talking about Jack's forecast, model forecast, not. But yeah, you're absolutely right. Our base is higher. Another way of looking at it is that we just had a bad forecast in September.
as opposed to other months.
We have a vaccine, when back in September and things
are bleak.
Yeah, and it's really, we're in very uncertain times.
So if we assume that the gross amount that we had in September was correct, or October, whenever the last one was, and we didn't change anything, the increase would be 3.2. So that should probably be the lowest that we would go.
That's really a small bounce.
We have a higher base, I think. But in July, you added in the negative 31.9 for the tax refund amount that came in July of 2020.
Yeah, because you can just look at the amount. The amount for 2022 is way less than the one for 2021, and it's lower than 2020, and it's slightly higher than 2019.
Same as, 2018. Well, the average for the model is +8. That's the DOTAX multiple equation model, model 1.
But we adjusted the 2021. And we do have the double payment in 2022.
Well, the model is less than yours. You have a more pessimistic forecast than the model as well.
Who are you talking to?
Well, you guys just voted on a -6.5, but the median model is -5.8,
5.8,
right? So
Okay.
you would actually expect if you wanted to use the model, you would expect it to be higher. If you
Right.
wanted to
Okay, I
get
get your point. Yeah, I see your point.
So just to play the pessimistic advocate, because I know someone's got to do that.
Someone else has got to do it.
For fiscal 22, I mean, the federal stimulus that we'll be receiving in the first quarter of this calendar year, and hopefully additional federal stimulus is going to wane at some point, right? And then when you start making now, I actually, on the calendar year basis, our income forecast for calendar year 21 is much lower, obviously, than calendar year 20. And on a fiscal year basis, actually, I'm going to look at the personal income. Yeah, the forecast that UHERO has for fiscal year 2022 is lower than fiscal year 21 because of the expectation of waning federal support.
Right.
So the waning federal support is large enough to offset gains from reemployment and returning visitors.
I agree that PPP2 is harder to, more businesses will be having trouble trying to meet that requirements of the PPP2.
So Carl, just curious with regard to your model, does it factor in those behavioral changes you mentioned about pent-up demand and the savings?
No, it's not. That's not something that we were trying to. So it really is just reflecting sort of historical behavior, not the increased savings. And yeah, good point. Yeah, I mean, there's a huge amount of uncertainty about that, and you can imagine that if we actually do get back to normal, despite the fact that there are many restaurants that have shut down, there will be plenty of demand for new pop-up restaurants and new business creation.
I mean, historically, hasn't the snapback been pretty sharp? Like, what was it in the Great Recession? Was it wasn't it over 10%?
I don't have the exact numbers, but there were a couple of years, or at least one year over 10%.
Because we're going to have, last year was negative, what, 7?
Last year
this year is negative
6.3.
6.5. I'm sorry, 7.3?
6.3, minus 6.3.
Oh, minus 6.3, and this year minus 6.5 is our estimate.
On a calendar year basis, I don't have the fiscal year numbers, but on a calendar year basis, general fund was down almost 13% in 09, and then it was up 7% in 2010, 8% in 2011, and 13% in 2012. And the thing that I think will ultimately will play a big role in what kind of bounce back we get in the economy is how much restriction of state spending happens, right? So while we're getting the federal money now, if a year from now, we're looking at 10% furloughs and widespread government spending cuts, state government spending cuts, that will be a drag on the economy.
Mm.
But the short answer is yes, you do expect a bigger bounce back, right?
Mm.
Well, from what I've been hearing, DBED had projected it'll be about 5 years before we recover from this downturn. And
If
I
you
didn't
asked Eugene why he projected that, the projection was basically, well, that's what it took after the Great Recession. I mean, that's what he'll tell you, is that it was based on historical behavior. Our forecasts are that it will take 5 years for recovery as well. But in the Great Reset, but that's not because of, anyway. If you look back at the Great Recession and it took 5 years to recover, but you still had 3 years of high single digit or double digit tax revenue growth after 09, even while the economy was in the process of recovering. Does that make sense?
Well, you also have to look at what the starting point is.
Yeah.
And if you're looking at it from in terms of general fund revenue, 2019, $7.1 billion is what we got. And even the numbers that I'm looking at now at Seth's spreadsheet, that we're talking only about 6.6 billion in 2022. So we're still leaving 500 million off the table, if you will. And so we, even in 2022, nobody's talking about a recovery, even if you increase it even more than the current, well, what's on the spreadsheet is 5%. But even if you increase that, you're not going to get back to, you're not going to recover to 2019 levels. Let's put it that way. At least not.
I'm sorry. I think there's a little bit of a lag. I don't mean to talk over you, Jack, but we've got to remember too that 2021 does have that double tax collection, the 300 million. So even though, I was looking at this and throwing in numbers like on here, 10% increase, but we don't have the 308 million extra that we have in 2021. So that's a lot for 2022 to get over.
Mhm.
So figuring out, just throwing in 10%, which is what I put in there, which may be a little bit too aggressive, it comes back down to 4.6% for 2022. And that assumes a 10% bounce back, which may be too high.
Well, just to put things in perspective, the minute you have if we go from like the September when we have no tourists to when we have tourists, Hawaii collects $125 million in taxes every month extra. Right? That's what we lost by going from zero to have 0 tourists. So you just take 125, even if you don't, you take 100 and you multiply that by 12 and you get $1.2 billion more. It's like a lot, right?
Yeah.
And if you look at the assumptions that DBED is making in their forecasts and the assumptions UHERO's making, and they are assumptions, right? It's because no one can tell you what will actually happen with tourism. But in all cases, we're assuming recovery of tourism by the end of this calendar year to levels 70% or above of 2019 activity. So there's a lot of recovery there. It's mostly built into next fiscal year, right? It's built into the second half of calendar 2021 because of an assumption that the vaccine is going to get out there, and with the new administration we'll actually have a concerted, well thought out plan to vaccinate people. So if we're actually back to say 70 or 80% of 2019 levels by the end of calendar 2021, that's a really fast bounce back. That's a very, very fast recovery.
So we're going to go from 20% now to about 70% next year. Is that what you're assuming?
In December, we were roughly at 25%.
Okay,
and by and we're assuming that will remain relatively flat for the next several months, and then it will accelerate to end the year. December of next year would be at about 70% of 2019 levels. So we'd be at around probably 20,000 visitors a day, something like that, maybe a little higher by the end of 2021.
Oh, Carl, what was the number you said you expected to be at by the end of 2021?
In our baseline assumption, it was 70% of 2019 levels. So that would be something on the order of 20,000 visitors a day, roughly.
But that's just at the end of the year, right?
That's
so
December.
you're ramping up. You're
Ramp
ramping up in some fashion up to that point.
Yeah, and DBED's assumptions are higher than that. Theirs are more like our optimistic assumption, which is 80% by December.
Jeez.
Yeah.
I guess what were your assumptions when we have this West Coast and Japan surging of the virus? How long will you think that it'll take before that is under control so that people will start traveling again? You're assuming that July, is that what you're saying?
The assumptions that we were making were that there would be essentially no additional improvement in tourism until March, at which point you would start to see small improvements. And that was really, and you know, you didn't get to 40%, say, right? We were at 25% in December. We're at about 20% for the first 6 days of January, and you know, you end up at about 40% by April, and then from April to the end of the year, you gained another 30%. So it's really a second half of the year based on a combination of things. One is vaccinations, and two is increased testing, both of which were assumed really because of a new administration, right? That would actually have a unified plan. And part of the reason for assuming, so we were looking at this as a December, January, February surge on the mainland, was because past surges have looked like that. Now, obviously, with the new strains of the virus, that could change, but it could also be changed by increased vaccination and increased testing.
Yeah, I think that, you know, if you look at Dr. Fauci's latest estimate about when we will be getting back to normal, it would be mid-fall of 2021, some semblance of normality, because we have a lot of people who are also refusing to get vaccinated.
So I think that's consistent with what we're assuming, right? I mean, we're assuming that something close to normal, 70%, say, doesn't happen until December. And you know, I wouldn't call 40% in April anything near normal. And you know, we saw almost 25% recovery in December alone. I mean, there is pent up demand, and as more people get vaccinated, even though, you know, we're not back to normal, right? We're still wearing masks and we're still social distancing, but as people get vaccinated, there's going to be greater willingness to travel.
I think that we have to add something in that it depends upon how the local government officials treat, or, you know, what actions they take here to shut down the economy as far as travel, well, I think that social distancing and masks and all that will still be here, but as far as whether there'll be more travel restrictions, I think that is kind of critical.
So the letter needs to reflect that we're not assuming a renewed shutdown in travel. Basically, we're assuming status quo for the Safe Travels program.
I disagree. I think your April, May, and June is your zero, right? So you're for April, May, and June of 2020, you're assuming worse than any April. Like, I think you're assuming a shutdown.
So, but remember that we're not really forecasting April, May, and June, right? We were demonstrating how absurd the assumptions were to get to -7, and we weren't successful, right? we still ended up at -6.5. But we're not really assuming 0 in April, May, and June. You see what I'm saying?
I don't, because I think, well, it doesn't matter. You guys voted on it. I'm just saying you guys have it doesn't matter, but you have a pessimistic scenario already, right?
Yeah, I agree with you.
Well, I think it depends upon what's happening to the virus in the mainland and around the world.
So let's keep in mind that we're talking about fiscal 2022 now.
Yeah, we are.
Okay. And it obviously depends on what's happening to the virus and what happens to the vaccine, what happens to state policy, what happens to federal policy, and the list goes on and on and on.
That's
right?
correct.
And
A lot of
and
assumptions.
we have to do the best we can.
Okay.
So Christy, what were you thinking? Because you were playing with the numbers and.
But when I threw in, that's why I'm trying to compare it to what is on the board here. I put 10% across the board to, and came up with 4.6% because I guess it's taking into account the extra taxes that were paid for fiscal 21. So I came up with 4.6% positive for 2022.
Right. So it's, Christy, did you say 6.0% positive?
4.6.
4.6.
That assumes a 10% increase across
Just
the
like
board,
July.
but
Yeah.
not, and subtracting the extra tax payment we got in fiscal 2021.
Okay.
And so are you comfortable with that?
I'm comfortable with that.
I'm
Jack and
comfortable
Carl,
with that too.
Jack and Carl, what do you guys think about that 4.6 positive?
I think it's a bit low on the basis of the fact that we tend, you know, our rebounds are usually better than that. So, but you know,
This is a
there's so much uncertainty here that,
yeah.
you know,
This is
any number.
I was going to say this is a 10% increase across the board. So that's
Yeah. So Seth, can you put 10% in for August and September? That's a 10% across the board. That's your 4.6, and that include that also has factored out the 300 million from the tax shift, the revenue shift.
Sorry, what we've actually done, we did a -100% already in 2021 to get to the 6.5. So we basically said we collected it once in July and we completely wiped it out of April and May in 2021. So to say that we're taking it out again, I feel like we're actually cutting ourselves down even farther.
No, we collected it in July of 2020. So we're making the adjustment down from
Those
July.
were the payments from the year before.
That's correct.
And then we took a -100%.
Yeah, so it's actually the real number for the -6.5. And trying to understand, you're trying to say it's we're double counting by making an adjustment for that?
Well, so what we did, if you scroll back up a little bit, Seth, so we're saying we collected the 308 in July of 2021.
Yes.
And those were taxes due from
There were a combination, some due from 19 and some due for
2019.
what are some of the estimated taxes for 20?
Typically, we would get tax return payments in April and May. And so that's why Seth had built in that this variable up at the top, this -100%. But typically that payment would come in April and May. And we took that payment completely out of 2021 because we said the tax base was going to be smaller. There was going to be less taxes due. So we've completely wiped out that tax base now with this model. And so we're saying that we're only coming back 10% off of that negative 100% on $300 million. So I think that's why we're getting so low at this 4.6%. But we will have some sort of tax collections in fiscal year 2022, whether they're in July and April, you know, timing wise, it will move, but I don't think it will be zero.
Yeah, I think that's a good observation, Jessica, because that's why you have super low numbers right here, right? And this should be a more normal year.
Right.
Like you can look at the graph, like the current projection is to have something only like 3 or 4% better than, or 5% better than 2020 in 2022.
I think that for when I looked at the numbers there, people are just not going to have the kind of income they had in the prior year for 2021. So it's, to me, it's not like double counting. It's just reflecting what happened in 2020 with respect to people's income. A lot of it is not going to be taxable. So, you know, the stimulus funds are not taxable. The rent payments for individuals won't be taxable. So you're going to have a lot that's not being taxed that people are getting, but it's just not going to be taxable.
So
But if we look at
what we're doing is we're talking about you know, the period of the year when we get most of our revenue, right?
Yeah.
The April and May period when, and we've lowered that base in 2021. And so then that suggests that the growth rate, you shouldn't do a 10% across the whole year, right? When you get to the second half of the year and you get to the April-May period, the growth rates should be higher because it's off of such a lower base. And that's why we're getting a low number for the whole year. It's a combination of things, and the important one I think being that we're using this constant growth rate and we're not accounting for the fact that we've really yanked the biggest part of our base down.
Right.
So do we really expect that?
So I see in July we're collecting 550 million at this 4.6, which is more than we collected in 2019, July 2019.
So that one might be a little high. No?
But in April and May, I mean, you look at April of 2022 and May, you look at May of 2022, it's barely even half of May of 2019. I mean, well, it's 400 million instead of 700 million. I mean, it's barely even as much as in May of 2021.
Yeah, that seems too low. I agree.
Yeah, and you know, I don't think we want to go and pick every single month's growth rate separately, right? And so
right.
I think, yeah, good catch, Jessica.
Yeah, I think we can play with the numbers in other months. And
we're maybe too high in some months, but yeah, we
too low in others. Yeah.
Yeah, too low in some other months.
Well, so we're seeing a 4.6% here. The model says, model 1 says 8% on the, you know, is the average of our inputs. You know, how do people feel about 6%, let's say? Are we still talking, or is everybody, or are people thinking we're going to be below 4.6? I don't think so. I think we're going to have a bigger rebound.
I would agree that we're going to, the math just is the way it is. I think we're almost it's almost inevitable that we're going to have a good rebound. And what did you say, Jack? 6? How do people?
Well, I
feel
mean,
about-
you know, the model says 8.
Yeah,
And
that might be a little aggressive. Only because of the extra 300 million and trying to get over that. But we don't want to count it twice.
but the 300 million is out, you know, out of the numbers now. If you look at 2022, fiscal 2022, you know, the 300 million, there's nothing, it's not there in July.
Well, it isn't in this model because Seth took it out, right? But it factors into the percentage at the end. That's why when we put 10% across, it ended up at 4.6.
Right.
So if you put 11.5 across, you get 6. And then, you know, you can look at the individual months if you wanted. That helps you be comfortable with the forecast, with comparing the individual months from year to year. I don't know if that helps or doesn't, but.
I had a question with regard to fiscal year 2022. There was an adjustment, below the line adjustment for TAT that was not offset by any income tax adjustment that lowered the amounts of the growth rate for that fiscal year. So you see,
Is that when the law expires that transfers the TAT to the general fund? Seth?
What year are you talking about? I'm sorry.
fiscal year 2022 and table 6AA.
Mm-hmm. What year? 2022?
Yeah,
TAT.
it's a below the line adjustment for taxes.
Oh, that's this.
There's probably a footnote. No, that's usually because it changes every year because the mass transit fund.
So
The transit fund is 1% of TAT.
okay, so that's why it's being subtracted out because of TAT coming in and then going out.
Yeah, because it doesn't go to the general fund.
So our number,
TAT collections, right? And then you subtract out the 203 million, and plus on top of that, you subtract out the mass transit fund, which is 1% of all the gross receipts of transit and accommodation collections.
But the transfer to the counties was suspended, correct?
However, that we don't include that in our models because that's not a law, right? It's a executive order, so the governor can end that next month. So we did not include that into our models.
Mhm.
so that's the transfer that's going to be made.
Yeah.
But was it included, Seth, during the suspension period?
We backwards looking, yes. Right.
You
So
did.
for preliminary, yes, but we don't make any expectations about what the governor is going to do with emergency proclamation. Just out of deferment to my staff, it's like there's 3 or 4 people sitting here. We have 2 more votes to go. So just as a reminder.
I move that we adopt 6% for fiscal 2022.
I'll second that.
Any further discussion? Marilyn, do you have any comments?
No, that's fine with me.
You good?
Yeah.
Okay. Any comments from Councilmember Glucker?
No, I'm comfortable with 6%. I think that's.
Councilmember Hayashi? Oh, sorry. Did you finish?
Oh, I was just saying that it's on the low side, but I think it's reasonable.
Okay. Councilmember Hayashi, do you have any comments?
Yeah, I'd agree. I think that's low based upon the rebounds that Jack was suggesting, but once again, to Carl's point, I mean, our margin for error is probably much more than 2-3%. So, at this point in time, I think that's fine. 6%.
Okay, we'll take a vote. Vice Chair Niwal,
Oh, who made the motion?
Carl made the motion and Christie seconded it.
Okay,
Okay,
yes,
So positive 6% for fiscal 2022.
yes,
Dr. Siderhouse,
Yes.
Dr. Bonham,
Yes.
yes. Okay, Councilmember Maynard,
Yes.
Councilmember Gluck,
Yes.
yes,
Sorry.
and sorry, Councilmember Hayashi.
Yes.
Okay, it's unanimously carried. Okay, the next 5 fiscal years. What have we projected for the next 5 fiscal years?
It's like
6, 4.
6 and then 333.
64333, right?
Yeah. Can I just make one comment about your, in the past, you guys had done 4 in the out years, and now you've chosen 3. And I understand that the reason behind that is you just take real growth and then add 1% to that. I would like to point out that our tax collections grow faster than just normal inflation plus growth, because we have in our individual income tax, which is for about 30 or 40% of our income, is not adjusted for inflation. So we get, on average, our individual income tax goes up by 5 or 6 a year, 5 or 6 percentages a year. And then if you look over the long-term horizon for general fund revenues, they go up with recessions about actually around 4.8% a year. So when you do the 3, you are deciding that it's going to be lower than the years past.
Understood.
I think one of the things that entered the discussion previously was the population trends.
Yeah,
or
I think we were
depopulation
actually,
trends.
I think we were actually intending to forecast lower than average when we were adopting those forecasts last year and maybe even the year before. We were progressively lowering that forecast as the expansion was waning, and we were looking at falling population, and it's but your point's well taken, and there certainly is risk of rising inflation over the next few years with all the pent up savings and pent up demand. So I will make a motion in the interest of time and lack of real additional information about what 2024, 2025 and beyond will hold. And I will move that we adopt 6% followed by 4%, and then we carry the 4% out through the end of the forecast horizon.
Just to make sure I heard you correctly, Carl, you're saying 6% for fiscal 2023 and for all the other years, 4%.
That is correct.
Okay. Any second on the motion?
I'll second.
Okay. Any further discussion? Vice Chair Niwal?
Oh, sorry, Kurt, I'm just
ahead.
curious. So, Seth, in the past, I think the assumption was we'd get back to kind of our 2019 levels by 2025. With those adjustments, are we close to getting back to the 2019 levels by 2025?
Let me.
Yes.
I think sooner than that.
7.1. 2024 is what we have right now at 6 and 4 for.
So
I think it's 2019, right? 6 and 4.
we definitely get back to 2019 levels. We exceed them. We actually get back to 2019 levels in 2024.
So it's 1 year earlier.
So by my calculation, 2019 was 7.14, 2024 would be 7.3, and 2025 would be 7.6. If I did my math right.
for those growth rates?
Yeah.
for all
So
of our
between
growth rates,
fiscal year 23 and fiscal year 24 is when you get back to it.
right?
Great, thank you.
Anyone with any further discussion? Okay, we'll take a vote. Vice Chair Newell,
Yes.
Dr. Siderhouse,
Yes.
Dr. Bonham,
Yes,
Bonham,
yes,
okay. Councilmember Maynard,
Yes.
I'm sorry, you said yes?
I said yes. I think there's some static in
Yeah, I
the
think that's
line here.
static.
Yeah.
Okay, Councilmember Gluck,
Yes.
Councilmember Hayashi.
Yes.
Okay, so the motion carries unanimously. There'll be 6% for fiscal 2023. And for all of the out years, it'll be at 4%. Okay, what is next?
Donovan's briefing?
I'm sorry, we have the BNF, right?
Yes.
Okay.
Good afternoon. I'll try to keep
Good
this
afternoon,
very
Donovan.
short.
Mr. Chan.
Good afternoon, Chair, Council members. My name is Donovan Chun, and I'm with the Department of Budget and Finance. We have provided you with a report of revised projections of general fund non-tax revenues, non-general fund tax, and non-tax revenues since the September 9th meeting. Our report includes a summary of significant changes. I will very briefly highlight a few items of significance. And a general statement is that, these reports, these revenue updates were prepared by the departments in November and the early part of December. And were based on the information they had available at that point in time. On table 2A, general fund non-tax revenues, under non-revenue receipts, the net increase in fiscal year 20 is reflective of a transfer of $648 million from the Emergency and Budget Reserve Fund to the General Fund. This was pursuant to Act 9, Session Laws of Hawaii 2020. And the change in the same category, in the change in FY21 is primarily attributed to a working capital loan of $750 million.
Donovan, is that the rainy day fund that we're talking about? That big?
The Emergency and Budget Reserve Fund, yes.
Okay, thank you.
I'm going to skip something and come back to it. On table 4A, which is special fund non-tax revenues, under non-revenue receipts, the net increase in FY20 is primarily attributed to infusion of $303 million. This came from general funds and special funds to the Emergency and Budget Reserve Fund. This was pursuant to Act 4, Session Laws of Hawaii 2020, as amended by Act 9, Session Laws of Hawaii 2020. So this and that first two items I talked about, basically the legislature shifted monies around to have enough money in the Emergency Budget Reserve Fund to transfer to the General Fund. And then on table 5A, which is other than special fund non-tax revenues, under federal grants, in fiscal years 22 to 27, the net increase is based on projected increases in medical assistance payments based on higher capitation rates and enrollment rates due to COVID-19. So that's projected at about 236 million. I'm going to skip back to table 3A, special tax revenues. I think it's the fourth item. There's a new line in there. I just wanted to let you know. Electric vehicle and alternative fuel vehicle surcharge. It's not a significant amount at this point, but it is a new tax that was established by Act 280, Session Laws of Hawaii 2019. Basically, if you have an electric vehicle or an alternative fuel vehicle, there's a fee that you have to pay when you register because you're not paying a fuel tax, yeah. I guess that's for highway maintenance. And I just wanted to point it out because it's a new line on that page. But that's it. The rest of the items with significant changes are reflected in our written report.
Any questions of Mr. Chun? Okay,
Thank you, Donovan.
Thank you, Mr. Chun. Okay, is
We
there a
need to,
motion?
I'll make the motion to receive the report.
Any second?
I'll
Second.
second.
I'll second if I can ask a question.
Okay, go ahead.
On table 4, so we've got, this is special fund revenue, and you've got the adjusted total, which I think we can thank Paul Brubaker for getting these totals included in these tables many years ago, but goes from 2.3 billion to 2.15 billion in fiscal 2021. This is the source of funds that Representative Sylvia Luke is talking about as an option for reaching into to help fund general operations. Am I correct?
Okay, sorry, I want to make sure I'm looking at the right numbers.
I'm asking you about the total dollar amount in special funds.
On the very bottom.
Yeah. Yes.
Well, this reflects mainly just the revenues to those special funds, but
And not
yeah,
balances.
not the specific balances of each of those funds.
Right.
Yeah,
Okay.
but yeah, it is within those special funds that she's looking at.
Okay. Thank you.
Thank you.
Okay. Thank you, Mr. Chun. Okay, we have a motion to adopt BNF's report. Any discussion? Okay, we'll take a vote. Vice Chair Newell,
Accept, yes.
Dr. Sidehouse,
Yes.
Dr. Bonham,
Yes.
Dr. Bonham.
Yes.
Councilmember Maynard,
I accept, yes.
Councilmember Gluck,
Yes. Yes.
and Councilmember Hayashi.
Yes.
So it's unanimously approved. Last item on the agenda, actually, I wanted to ask the director if there's anything further we should do on the letter to the Council of Revenues.
You mean my letter to the council?
Yes, your letter. Would
Yeah.
you want a response or?
No, I accept your methodology for answering
I'm
it.
sorry?
I accept your methodology for answering it and awaiting the legislature to deal with the conformity bill.
Okay.
And then
I want to ask,
price it.
okay. So you're leaving it
I'll
up to
price it.
us?
I'll price it well.
I'll help you with the pricing.
Yeah, I'm gonna call Marilyn and we can
Okay.
figure it out.
Yeah.
So we should probably do some kind of formal response, right?
It's up to you.
Yep, your pleasure, Chair.
Why you get the big bucks?
Hey, wait a minute.
So we responded. Okay.
Next meeting?
Yeah. Okay. we'll take it up. This has been a long meeting already. Okay, we'll take it up at the next meeting. So the schedule, when are we supposed to report?
March
Dr. Kobe?
15th.
Is it by March 10th or March 15th?
15th.
March 15th.
Yep.
Thursday, the 11th.
How is the afternoon of March 11th?
At 2
for
p.m.?
Does that give you enough
that
time,
okay?
Seth?
Yeah, I'll talk about this, but like when you guys have a lot of demands about how you want to write a letter, it like right now we're on a tight turnaround for tomorrow. We got to turn in tomorrow, and my guess is all of you will have different opinions on how this letter should be, unless you guys want to write it.
No.
Yeah, I usually write it.
Really good
Right?
job writing it.
Okay, so
But if
I'll
you
get
could
the letter to
circulate-
you tomorrow. But
Yeah, if you could also circulate it among all the council members.
okay.
Okay.
Do you want
So the
more
next meeting-
time, Seth? Would
Next-
Wednesday or Tuesday work better?
It works a little bit better, especially if we're talking about all this complicated.
Back stuff.
Do we have an idea about the legislative schedule? Normally, it's kind of slow that time in March, but that's on the regular schedule. Because you have the first crossover or first decade, I think that takes place either end of February or first week in February. So normally that would be slow, but
To me, it's not about the legislative session. It's about getting a letter to you guys, just getting it out the door in a day. Actually, since
So
it's
you would
due on the
prefer-
15th, we should be okay. We can handle it.
How about the
So-
8th?
I don't know if we have the February revenue though.
Yeah, we will. 1, 2.
You have it by the 8th?
Yeah.
By March 8th?
Yep.
Okay. So how is the afternoon of March 8th at 2 p.m.?
It's a Monday, right?
Yeah. You don't like Mondays?
No, it doesn't matter.
Are you retired people?
They're all the same.
Every day Sunday. I'm good any afternoon that week. So Monday, Tuesday, Wednesday,
Okay.
I can make work.
Everyone else?
Pick a day.
How about Tuesday?
Tuesday, March 9th at 2 p.m.
Mhm.
Is that good for everyone?
Uh,
think-
Or-
The Tuesdays, the March
Yeah.
9th.
Tuesday the 9th.
Yeah, kind of tied up on Tuesday.
Okay.
You rather have it March 8th,
Yeah,
Marilyn?
I'm
I'm
okay with the
okay.
8th.
Is it a general revenue
Yes,
meeting?
yes, general fund.
I'll block out the afternoon.
I move that we adopt March 8th at 2 p.m.
Okay. Okay, is everyone okay with March 8th, 2 p.m.?
Yes.
Okay, we'll set it for March 8th, 2 p.m. Okay. Okay, thank you, everyone, and Happy New Year. And
Happy New Year.
So just to be clear, you want me to write the letter and then get
Yes.
it to everybody?
yes, circulate. for
I'll
input.
have the letter by tomorrow. I think tomorrow's the due date. Yeah.
Is tomorrow the due date?
You don't get a relaxed due date due to COVID restrictions?
No, it falls on the 10th on Sunday, so it moves to Monday. So I think we'll be okay. I'll send it out tomorrow by 10 a.m. and hopefully I can get everything. If you guys could respond by 2 or 3 tomorrow, that would be a big help for us.
Okay,
Thank you.
okay. Thank you, Dr. Kobe.
Thank
Thank
you.
you.
Okay.
Thanks,
everyone.
Thanks, everybody.
Bye.
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 very
Bye.
much.